Hi everyone, I'm Kristy Sellars, and in this video today I'm going to be talking about investing in the stock market for absolute beginners. This is for the everyday person who has no idea what to do and is thinking about getting into the stock market. So the reason that this video came about is because obviously with COVID and the stock market moving up and down and sideways at the moment, some of my friends and family are thinking, oh, that looks like a good opportunity. Maybe I should get into the stock market. And they know that I have been investing in the stock market for a number of years now, so will ask my opinion. And I just kind of thought a video for absolute beginners would be really nice, because I know when I started, I really had no clue, and I had to Google a lot of the terms. I had to learn as I went, and I felt a bit silly because I thought, oh, the stock market is for investors and it's not for everyday people like you or me, and that's just not true. And I learned a lot as I went. I'm not a financial advisor, so this video is just about my experience, and you should always get advice before investing in anything. But I just thought I would share some of what I learned at the beginning, and the differences in the terms, and just to have a better understanding of it. So at least if it is something that you're thinking about, you have a little bit more knowledge, or at least can learn from my experience, my mistakes. So yeah, let's jump in. A lot of people do say that the stock market is volatile, and it can be. The stock market can be two things. It can either be a long-term investment, or it can be a short-term gamble. A lot of the time when people buy a stock, and I should say as well, stocks and shares are the exact same thing. I had to look that up because I did not know, and it's just terminology. People use it either way. Share market, stock market, it is the same thing. You can buy shares, you can buy stocks. They are the same. So yeah, if you buy a stock or stocks in a company, shares in a company, and that company price plummets, then yes, you will lose money if you sell at that time when the stock is down. That is why a lot of people feel that the stock market is very volatile, because when we have these bubbles like the dot-com bubble, the housing bubble, the probably COVID bubble, people feel like the stock market crashes and then they lose all this money. The only way that you lose money when there's a crash is if you sell at the bottom of the crash. So if your strategy is long-term, and I'm talking like 30 years, then the market, has in all of history over time always come back up and gone above and beyond. Yeah, so that's probably the first thing, is when you're thinking about getting into it, you need to have a very clear strategy. I would never invest money that I needed in the next 5 to 10 years, such as a house deposit, or trying to put money in to make it grow to become a house deposit. You need to think about the money that you put into the stock market as money off to the side, kind of doing its own thing. If you put in money that you need, or for example, if you're 60 years old and you want to retire by 65, 5 years is not a lot of time. And if the market does have a crash right before you're meant to retire, then you're going to be in trouble. Whereas, a 30-year strategy, if you're 25 or 35 years old, you've got a number of years in front of you that you can invest and allow it to kind of go up and down and grow over that time. So yeah, the way I kind of think of it is two different types of investor in the stock market. And one is the long-term investor who is interested in the dividends, which I'll talk about in a second, and the short-term investor who is interested in the stock price or the share price. Now, you would have heard it before. Someone will say, oh, this share price is meant to like skyrocket. This company is going to skyrocket. You should buy shares in this company. And people have said that to me because they know I invest in the stock market, but that is not my strategy for the most part. I have done it a couple of times, but I consider that literally gambling, because you're putting money in hoping to God that it goes up. And It may not do that. It may, but then it may crash. And if that's all you're relying on, then you're literally just putting money in for the capital gain, which is the growth only on the money that you put in at the start, hoping to, you buy it at one price, you're hoping it goes up, and you sell it at a higher price. That is a capital gain. So people who are investing like that, such as day traders, which obviously they're people who buy and sell in the one day. You've seen them on the movies, buy this, sell that, whatever. Obviously they look at things in a different light, and they're very far from the way that I invest. I'm an everyday person just trying to create financial freedom for my future. So yeah, I would try to avoid that unless you really feel passionate about it, but be prepared to lose whatever money you put in that. And I have done it before. I've put in, you know, $1,000 or whatever onto a stock, deliberately thinking I'm okay with losing that money. I'm prepared to lose that money because I know that I'm gambling. So far, that hasn't, I haven't lost out by doing that, but it's not my strategy to secure financial freedom for my family. So the way that I do invest is to buy companies who pay dividends. A dividend is basically a piece of the pie. When a company makes money, as an investor, as a shareholder, you get a little piece of that pie, and they pay out every quarter, which is every 3 months of the year. So the idea for the long-term investment, I don't care if the stock price of these companies goes up, down, or sideways. I do not care. All I care about is the money that they pay me every quarter. That's what I care about. And that may be a really small amount depending on how much you invest into that company. But over time, that is going to accumulate. And if you when you buy the stocks, they will send you a letter, and if they offer a dividend reinvestment plan, which is a DRP, it means that any dividends that you make, they will automatically reinvest it in the company to give you more shares or more stocks. So yeah, so it's a really good way to grow your wealth in a cumulative way. So you could just get the money land in your bank account every quarter and take that out and spend it on whatever you want. But like I said at the start, you want to think about this share market money, or this is how I think of it, as just working away in the background. You don't rely on it. You don't need it for anything. You just put it there and keep adding to it bit by bit, and it grows over the long term. So by having it reinvest, you get more shares, which pay more dividends, which make more shares, and they keep going up, up, up. And then there's this exponential growth, which means really fast growth. That is my strategy, to do it that way, so that over the long term, 35 years or whatever it's going to be, then by the end of it, you've got quite a lot there in your portfolio, which is your collection of investments. So yeah, so I hope that kind of explains the difference between investing for dividends and investing for stock price. So if you're investing for the stock price, you're hoping that it goes up, and then you're going to sell it when it goes up. Also, you should keep in mind that if it does go up and you sell it and you've made that capital gain, when you sell it, you'll get taxed on that gain. Whereas over here, the tax works a bit differently, and you're not in that same situation. Okay, so the next thing I'm going to talk about are ETFs, and ETF stands for Exchange Traded Fund. An ETF is basically a collection of companies. Rather than buying a stock or a share in one individual company, if you buy a stock or share in an ETF, you're buying into 100 or 200 or 500 companies. So depending on the ETF that you choose, it will depend on the types of companies that ETF holds. So it could be like a real estate ETF, and they hold commercial land or whatever. So the reason that I like ETFs, and also Warren Buffett, who's basically the world's greatest investor, is a big advocate for ETFs as well, because they they diversify your risk, which means basically spreading it out so that you're not putting all of your money into one company, you're spreading it across many. So if one of those companies goes under, you're not in as much or hardly any liability like you would be for the individual company. I hope that makes sense. So yeah, ETFs over the long term that pay good dividends are my main focus when I'm thinking about investing in the stock market. So yeah, different types of ETFs. You can buy them, like I'm here in Australia, so there's Australian ones, there's also international ones. They are very, very good for diversifying and not having all of your eggs in one basket. And if that ETF company pays a good dividend, then that's golden. So that is the long-term strategy that I try to keep my mind around. Occasionally, like I said, I'll dabble in like individual shares, but the main focus for me is over here in the ETFs that pay good dividends over the long term. So it wouldn't matter if the stock price of an ETF goes up or down, like I said, and it's the same for the individual companies, but it doesn't matter if the stock price goes up or down or sideways. You want the dividends that are paying out every 3 months into your account or back in to buy you more shares to grow your wealth over the long term, rather than hoping that a share price goes up and then trying to sell it at that, which, you know, many people do that. That is fine. Like I said, this video is just about my experience and what I've done. So the next thing was just that there is the option of investing directly. So if you're here in Australia and you're with CommBank or NAB or one of those, they have, so for CommBank, it's called CommSec, which is an app that you download and it connects to your CommBank, your ID, and basically just sets up a trading account. It's so easy, literally can be done in a few minutes. And it connects to your normal banking ID. So they already know who you are. You press, I think it's just the trade button, and you can either buy or sell, and you can choose how many shares or stocks you want to buy, or you can set a price limit. There's a few different options. It's pretty straightforward. To make a trade probably takes 30 seconds, and I think there's a flat rate of like $19 per trade. So it's very, very, very easy to do that part of it. I'd probably recommend, just seeing as there are so many options, to just call up the customer service and say, I've never done this before, can you please walk me through it? And they will do that. So provided you sort of do some research into which companies or which ETFs you want to buy, then you can just explain to them what you're wanting to do. You could say, like, I have $500 that I want to invest into this company, and then you can just do it directly right there on the spot, which is really cool, because then it's done. You don't have to think about it. You put it away in the background and it's working for you. So the other way that you can do it, and I do both of these, is to invest through your super. So some super funds will allow you to use your super money and invest in the share market directly through your super. So it's separate to your regular money, because obviously you can't access your super until you retire. So that is a good way to also be able to invest in the things that you want, rather than letting your super fund choose what they want to invest in for you. I'd probably recommend just being quite sure about the investments that you're choosing in that. But like I said, get some advice. This is just an overall view. So yeah, you can do it directly, or you can do it through your super, which is really cool. And then the other thing to know is that each stock or each share has a 3-letter code. So if you take the code ASX, for example, that stands for Australian Stock Exchange. If you take the code NAB, that is National Australia Bank. So that's the actual code for that company on there. When I first sort of looked at it, and you see it in the movies, it's like a matrix of numbers. It's actually not that difficult to understand if you look at it each week for maybe 3 minutes. Like it's got the name of it, It's got the price that it's selling at. It's got the price that it's gone up or down. It'll show you a percentage of how much it's going up and down. And yeah, it's very, very simple. So yeah, I think that was sort of the main things that I wanted to cover. I won't go into, like I said, exactly how to buy or sell a stock, because each app is going to have differences. So I'd probably recommend, just if you do want to do it, do some research, you know, get some advice, make sure you're happy with whatever you're going to invest in, and then contact your bank or whoever you're going to be trading through. But the bank is the easiest. You just do it directly, and like I said, each trade costs like a flat rate of, I think it's like $10 or $15 or $19 for the total trade. You pay that when you buy it, and you pay that when you sell it. But if you're not going to sell them, you only pay it once. So yeah, I hope that's helpful. And if you have any other thoughts or any other things to add to that, please leave it in the comments. I'm doing a bit of a series of like business videos and just things that I've experienced and sharing that knowledge. So if you want to hear about anything else, let me know. Otherwise, have a good day.